my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of LME 3-month nickel, zinc and tin. LME 3-month nickel. The most significant feature of this market in recent weeks has been the very significant lows of 2021 at 15,665 and the lows of late November 2023 plus January and February this year down in the 15,840 zone. You see, this support zone has also now created the lows of late July at 15,600 and even last week at 15,665. It is at this point I feel obliged once again to mention the big descending scallop pattern that I've been going on about for months now, and what it may mean within the near-term universe. So the key levels are the lows at 15,840. A significant move below this, and by that I mean you would know it when you see it, a significant break below that level would give a potential for the descending scallop pattern on the downside in the 13,830 zone, which is not too far away from the potential below for the old bearish halfway hesitation seen over June and July that eventually never materialized. It still all comes down to what the market has done and would do upon reaching the 15,840 zone. Now, first time around in late July, prices chose to bounce upwards, and during the start of August sustained the bounce, moving higher, slowly higher overall. However, over mid-August, prices had an issue with testing the June 2021 low at 17,095, and I suspect indirectly the very slowly declining gold long moving average that's overhead. And that's currently at 17,295. This suspicion eventually evolved into a mid-July to early September ascending wedge pattern, highlighted in dark blue on my daily chart. Early 2 weeks ago, prices broke down through the now ascending wedge pattern, easily reaching the primary target and close enough to the secondary target down in the July low at 15,600, enough that I chose not to designate it. However, last week we have seen prices build upwards again, enough for me to draw a late July to mid-September bullish Andrews pitchfork. It is a nascent one, and I am quite prepared to retire it if it doesn't fit, especially if the support down at 15,600, being so close, finally gives way. If it does, well, the next support is the November 2020 low at 14,935. However, better support is between the congestion at 14,555 and the October 2020 low at 14,040. Though in truth, I am not sure how good this may be, given the ammunition we have overhead. The one other thing I'd like to mention is that we might just form a possible double bottom over the action from July to date. It is way early to really consider this, but keep it in the back of your mind in case the 15,600 July low holds prices up and we really start to see the beginnings of a pull back up. LME 3-month zinc. This is a very busy and colourful chart, and for that I apologise, but all these patterns do relate to what is going on right now. So let me explain. Prices peaked this year at the neckline of the September to December 2022 reverse head and shoulders pattern, currently at 31.41, with a horn top in late May. The market moved back down, rejected by this neckline, reaching the primary and secondary targets for the horn top, but the decline became hesitant in mid-June, especially when it had tested the interesting support, currently at 28.29, of the dark blue broken upper tine of the old May to August 2023 bullish shift pitchfork that had acted back then as an August 2023 to April 2024 upper bull channel line. Now, I would normally have retired this broken pitchfork, but this pattern still resonates even today. Anyway, I said 14 weeks ago, and I quote, "This is the first decent support we have seen, though I would not be surprised if prices do move further down near the middle tine, currently at 26.59, end of quote." Now, prices did indeed drop down there just below the middle time in early August. But this drop was not singular, rather it was part of the large, well, part not very large, but part of a small late July to date reverse head and shoulders pattern. 3 weeks ago we saw prices drive higher, not only over the neckline, currently at 29.32, but also over the June 2021 low at 28.10, the old dark blue upper time, the green short medium moving average currently at 28.02, and the medium moving average currently 28.63. This also countered quite strongly July's monthly key reversal down. I should always mention that one. Consequently, I last week laid out some potentials topside for the reverse head and shoulders pattern of a primary target X in the 30.09 area and a secondary harder to reach target X1 in the 30.87 area. What we had in the way to stop it was a congestion band between 29.58 to 29.65, which is still there being tested today, containing the April 2019 high at 29.59 and the 50% Fibonacci line of the big old 2008 to 2022 move at 29.65. Plus above it now the green middle time currently at 29.88, and that's of the February to August bullish shift visual, and then just over the 3000 level the July high at 30.22. This obviously was enough to turn prices lower in late August, especially I suspect the green middle time, such that last week prices tested back down below the long moving average, and the congestion generated during late July and August, but there they somewhat surprisingly held and have since moved higher. Last week I was going to retire targets X and X1, but chose to keep them on for one more week, and what I took to be becoming a rare bearish continuation pattern is also becoming a more usual bullish reversal pattern. As a consequence, I have also drawn a new early August to early September bullish Andrews pitchfork, highlighted in bright red on my daily chart, in a renewed hope in showing the bullish angle of attack of this market. We are right now just underneath the bright red middle time, currently at 29.45. LME 3-month tin. Over April and May, the market formed a double top, Adam and Eve type, leading eventually to the creation over April to July of a triple top. It also clarified the April to July sideways triangle, which you finally had a proper break lower late 9 weeks ago. The market followed on lower with a move down to the primary target, but not to the secondary, harder to reach target. Likewise for the triple top, prices reached down to the primary target, but not the secondary, harder to reach to achieve target. Prices finally halted their slide down at the congestion between 28.835 to 29.005, containing the July 2011 high at 29.005, plus the important slowly rising long moving average, currently 29.615, and the nearby neckline extension of the October 2023 to January 24 reverse head and shoulders bottom, currently at 28.060, and finally the 50% Fibonacci line of the March 23 to April 2024 move, down at 27.330. All these slowed, stopped, and at the start of August started turning prices higher, such that since that pushback up in late July, prices rose and got stuck in what I've been best able to describe as an accidental congestion area overhead, created by the medium moving average, currently at 32.095, the short medium moving average, currently 31.620, and the 50% Fibonacci line of the March 2020 to March 22 move at 31.845, and the neckline of the thin and tall April base head and shoulders pattern. Yes, that one, the one I mentioned a lot back then, which is currently at 31.815. Coincidentally, this is where prices are getting stuck today, so watch out. Anyway, I said 3 weeks ago, and I quote, "This accidental area is actually the gateway to a whole load of congestion over here dating from early April until mid-July. Doubts about whether the market had the ammunition or the inclination to take things higher." End of quote. Interestingly, I also pointed out 4 weeks ago, now how beyond these, and I quote, "We have little in the way until the previous all-time high in April 2011 at 33,610 and the 50% Fibonacci line of the March to October 2022 move at 34,175, the latter being a significant level." End of quote. 4 weeks ago, all this looked good for a break higher, but the market was reading a different script, turning lower in late August and eventually down through all those previously listed supports, such that we started testing the July 2023 high at 32.05. To take this turn of events into account, I've drawn 2 weeks ago a bright red mid-July to late August bearish shift pitchfork. The market is at the moment close to the upper tie and above, currently at 32,275. Now, I chose the shallower bearish shift pitchfork instead of the more usual and aggressive bearish Andrews pitchfork here, as I thought back then, and I still do, that it was a better match. I also said 2 weeks ago, and I quote, "I am not in love with this pattern, and I would morph it into the more acute bearish Andrews pitchfork in a heartbeat, or even retire it completely if another better pattern developed." End of quote. Up until last week, nothing had developed or shown itself suitable to include here now, but I have this week drawn a late July to early September bullish Andrews pitchfork to perhaps show an alternative narrative to the one I've been describing. The market is currently between the lower time below, and I'm just going to get you that, which is currently at 39.50, and the middle time above, which is currently at 33,200. The market has now a choice, and it will have to choose by the middle of next week, for that is when the last of the tines for these two pitchforks, the last of them, cross over. I just wish to once again emphasize that we are yet again getting stuck today in what I had previously described as the, and I quote, "accidental congestion area overhead," end of quote, roughly between the medium moving average overhead, currently at 32,095, and the short medium moving average below, currently at 31,620. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.